For this autumn budget, we all said that we didn't want death by 1,000 cuts. But unfortunately, that's exactly what we got. The autumn budget set out a whole host of tax changes, and the cumulative effect of them all will shock everyone. 30 billion a year by 2030-31. That is what it will bring in for the government. But out of all the announcements, there are three key ones which stood out to me the most, and I feel that you and I really need to be taking very seriously. My name is Ruzwan Boota, and I'm a chartered tax advisor and a tax director at I Will Solicitors, which is part of the Wahid Group. And what I do on a day-to-day basis is come up with ways to help families and business owners save tax. So let's jump into the key announcements. Now, the first one is threshold freezes. The Chancellor announced that income tax, national insurance contributions, and inheritance tax thresholds will remain frozen up until April 2031. Now, let me make it very clear. This is not a minor change at all. This is likely the largest overall tax increase from a single policy in the post-war period. Yes, from a simple threshold freeze. And the numbers don't lie. In 2026-27, the freezing of the income tax thresholds alone will raise 32 billion in a single year. By 2029-2030, that figure will increase to 39 billion pound, again in a single tax year. Why? Because normal people like you and I will be dragged into the higher rate and additional rate thresholds simply as a result of getting pay rises to stay in line with inflation. In 1990, only say 6.5% of taxpayers were paying the higher rates of tax. Now in 2025, it is approximately 18% of taxpayers that are in the higher rate tax bracket. That is almost a 300% increase. By 2031, and the numbers are going to be much, much higher. Now, as crazy as the numbers are and the impact that it will have, know that this is just in relation to income tax. In addition, the very same freeze is also going to take place for national insurance contributions as well as inheritance tax thresholds. So a lot more people paying national insurance contributions and a lot more people paying inheritance tax, particularly when you factor in business relief changes for business owners in April 2026. And the fact that pensions will be exposed to inheritance tax from April 2027. The numbers are going to be astronomical, and everyone will feel the hit on this. Employees, business owners, investors, you name it, no one is spared. Why are they doing this? Desperate times call for desperate measures, I suppose. Now, number two, increase in tax rates on dividends, property income, and savings. From April 2026, tax on dividend income will increase by 2 percentage points. The basic rate will rise from 8.75% to 10.75%, and the higher rate from 33.75% to 35.75%. The additional rate for dividend income will remain unchanged at 39.35%. And from April 2027, tax on savings income will increase by 2 percentage points too, across all the bands. That means basic rate will rise from 20% to 22%, the higher rate from 40% to 42%, and the additional rate from 45% to 47%. Now, for property income, it is already subject to income tax, but from April 2027, it will have its own separate rates of tax now, similar to how dividends are taxed at their own rates. The property basic rate will be 22%, the property higher rate will be 42%, and the property additional rate will be 47%. Finance cost relief will also be provided at a separate property basic rate of 22%. Now, these changes will primarily impact business owners, savers, and property landlords owning properties in their personal name. Let me explain how. Now, business owners commonly use dividends as the way by which they extract profits from the business. And unfortunately, they really can't do much about these changes, as they still need to take funds out from the business to fund lifestyle costs. So yeah, it's going to be another hit for business owners, unfortunately. Now, for savers, it's going to be a hit for them too. I think it'll push many savers who are already high-rate taxpayers to start thinking more carefully about what they're doing with their savings. With inflation still so high, they need to make sure that their cash is working for them and not just sitting there earning interest in the bank. So I see many savers now potentially looking to start investing their cash rather than saving it, and perhaps even considering investing it via a company rather than their personal name too. Now, finally, property landlords. Now, I must admit, property landlords have already got it really bad. Tax change after tax change have eroded profits significantly, and these announcements only further add to their problems. This is going to further encourage property landlords owning properties in their personal name to try and move those properties into a limited company, which for many has been hailed as the promised land for property landlords. But please, guys, be careful. Partnership incorporation planning gets sold like it's the answers to everyone's du'as, but in reality, only very few people actually qualify for it. Don't fall for the advisors selling this to you without first knowing 100% that you definitely qualify. Get proper advice from people that will guide you responsibly. Now finally, salary sacrifice. What is salary sacrifice? The base position for most employees is that they are paid a salary at the end of the month, and that salary is subject to income tax and national insurance contributions. However, an employee can also elect to sacrifice some of that salary in exchange for a tax-efficient benefit, such as pension contributions. As a result of doing this, they will have saved income tax and national insurance contributions in the process. Now, in practice, salary sacrifice has been used by many people to try and keep themselves at the lower rates of tax. Let me show you an example. If you have a salary of £55,000, £50,000 approximately will be subject to the basic rate of tax at 20%, and 5k would be subject to the higher rates of tax, i.e. 40%. However, if you decided to do a salary sacrifice and have 5k paid into a pension instead, you will pay no income tax or national insurance contributions on that 5k. The remaining 50k only will be subject to the basic rate of tax. No higher rates of tax paid at all. You haven't lost out. In fact, you have saved lots of tax in the process. The very same thing is being done by people around the 100k salary mark. They are doing salary sacrifice initiatives to try and stop themselves from falling into the circa 60% effective rate of tax between 100k and 125k. And the stats back this up too. As you can see in the graph, there is a clear uptick in the bunching of taxpayers on or around the 50k and 100k mark. And most of them are because they are using salary sacrifice to try and stop themselves from going into that next tax bracket and paying even more tax. Now, what was the big change in the autumn budget for salary sacrifice? The government is changing how salary sacrifice for pension contributions work. From April 2029, the amount of salary sacrifice that will be exempt from national insurance contributions will be capped at £2,000 a year. Now, I kind of feel that this is a sneaky way of not increasing income tax rates and breaking promises in their pre-election manifesto. Instead of increasing income tax rates, they will try and increase the number of people in the higher rate tax brackets. Let me help you visualize this. The threshold freezes are already pushing people along the conveyor belt into the higher rate tax bracket. Salary sacrifice was being used as a wall, which helped people stay in the basic rate bracket as much as possible. As a result, people were starting to bunch up against that wall, with a few spilling over from time to time. Now, with the autumn budget changes, HMRC is chopping away at this wall, such that there is only going to be very limited use from it now. As a result, there will still be some bunching at the 50k mark, but a lot more people spilling over into that 40% tax bracket. Sneaky, I know, but I do wonder how this will impact on people saving for their retirement. Let's see. So there you go, guys. The 3 key tax announcements which you really cannot afford to ignore. And in all honesty, there's so much still to unpack in regards to the autumn budget. And we'll be sharing more information in regards to this over the coming months. Stay tuned for further updates and tax insights that can benefit you, your family, and your business. Assalamu alaikum.